And welcome everyone to another Smart Money Circle show. I'm Adam Sarhan. With me today are two portfolio managers. We've got Matt and Mike Thompson, who are co-portfolio managers at Little Harbor Advisors. Combined, they manage over 300 million AUM. There's three tickers. They run three ETFs. First one is MSVX. Second one is MSTB. The third one is MSTQ. Now, I'll let them talk about it because they'll do a much better job than I will. Matt and Mike, thank you so much for taking time and welcome to the Smart Money Circle.
Thank you, Adam. Appreciate it.
Thanks for having us.
My pleasure. So I always like to begin. Can you tell us a little about your stories and how you guys got involved and got here?
Sure. So Matt and I have been working together at various firms since 2003. I somehow convinced them to move back from Denver to the Chicago area where I was, and we've been working together ever since then. Kind of started out on the traditional buy-side portfolio management side of the business, both got our CFA credentials along the way. And then as we went on in our careers, ultimately kind of developed our own investment process that sort of melded with our investment philosophy of tactical risk management, over kind of traditional investment approaches. So that's, the specialty that we bring to the market with Little Harbor.
Oh, very nice. And then let's talk about your investment strategy. Tell us a little about what you guys do and break it down for us so we understand, please.
Sure. So we have developed and we use what we call the volatility dashboard. Is almost think of it like the third portfolio manager in the room with Matt and I. It's a method of analysis that looks at the insurance marketplace for the stock market, which is the VIX index everyone's pretty familiar with, and then the tradable VIX instruments around that. So it looks to that marketplace to produce a sort of daily outlook for the next 30 days. And it's generally telling us if the market state or the market environment is risk on, risk off, or neutral, kind of indeterminate. So we use that process in slightly different ways depending on what product we're talking about, but it gives us kind of a unique view of the environment that the market is in. And it updates daily, so it's pretty active in looking at what is going on in the VIX marketplace and the relationships there. What we're looking for are signs that have been coincident or preceded previous big equity market corrections. All big corrections in the past have sort of gone through these different market states that the volatility market has picked up. So we use that vol dashboard as kind of our non-emotional, quantitative-based third portfolio manager in the room to define the market environment that we're in.
Yeah, and I think what's really unique about what we do is, so we're obviously focused on risk management, which I think people have come to associate with hedging. So like downside risk is risk management. We think that's part of risk management, but also a bigger risk, actually, if you look over time, is the risk from hedging itself. So the expense of hedging can be an enormous risk to portfolios over enough time if you just continuously carry hedges. And so that's why we developed this system to not only tell us when it might be prudent to play defense, but also when not to play defense. And actually, that has been much more important for total return over the years. It's a holistic approach looking at that VIX market.
Interesting. So you're using the VIX almost as your guideline to enter risk on and or exit risk off. And then if it's an environment where the market's not trending and just going sideways, then you know not to push hard. But once the models, okay, beautiful. So you're tactical managers, you're actively investing. What type of environment, or without giving away the secret sauce, of course, but educate us a little bit on certain clues that you've seen. You said every major correction has had certain things happen in the volatility markets. Can you speak a little bit to that, please?
Yeah, so like what the dashboard is really looking at and quantifying for us are not just levels of the VIX. So that's part of it. Obviously higher VIX is higher volatility. That generally goes with market drawdowns and crisis periods. But what's more important for our signaling is relationships in the VIX marketplace. So you have the VIX index is one thing, and then there are a number of futures that trade based off of the VIX, and those are all at various points in time, up to 8 months out in the future. And so the dashboard is looking at not only the VIX index, but those futures themselves, and it's looking at relationships. So if the nearer term prices, so the VIX index is kind of the next 30 days, and then there's all those futures I mentioned. If the VIX index is above one of those, the next future, that is one good sign that something's wrong, that people are demanding hedges like for something right now that's here. And so when we see those inversions in that pricing, that's one of our clues to start moving to the defensive side, and vice versa. So like today we have VIX very low. The market's been rallying off of that correction in April. We see the VIX being very low and below all the futures, and that's the normal way insurance should be priced. And that to us is a healthy market. And this is, we're 100% exposed today.
Interesting. So it's almost like backwardation and contango in the futures markets for commodities.
Exactly.
That for VIX.
Yep. We've learned to stay away from those words. Sometimes, the eyes glaze over some of those words, but yeah, that's exactly right. There's a lot of information in those prices.
Love it. So a few things. Have you ever tried doing any of that with S&P futures or NASDAQ futures?
Yeah. So, the S&P and NASDAQ futures, if you're talking specifically to like backwardation and contango, generally in S&P futures, we'll take that as an example. The S&P overall dividend is built into that. So the move from backwardation to contango is not as informative as the move in VIX futures from contango into backwardation, a flattening in the VIX curve. So there's more variables in the equity index futures than show up in the VIX futures as far as like signaling a risk on or risk off environment.
Interesting. So do you look at you said you guys are correlation. So do you look at the VIX backwardation contango ratio compared to how the market is reacting? So in other words, if you get a signal to do something, but the market's not actually moving, would you wait for the market to move, let's say above the 50-day moving average or some other technical indicator? Or do you just say, hey, we get the indicator from the VIX dashboard from that, whatever you guys do, and then say, hey, we're going all in or out based on that indicator alone?
Right. So yeah, that kind of like dispersion, if you will, that you described doesn't happen that often. I would say a famous kind of historical example is leading up to February of 2018 Volmageddon. We saw the S&P rally pretty sharply in January of 18, but after the January VIX expiration in mid-month, the VIX complex started rallying and the VIX curve flattened up. At the same time, stocks were rallying. So we were getting kind of our yellow flashing warning, flattening in the VIX curve signal, even though the S&P was rallying. So we will act, it doesn't happen that often, but we will act independently just based on what we're seeing out of the VIX curve for our products.
I love that.
It stems from the fact that, the VIX index is drawn off of S&P 500 options trading, which is an enormous liquid market, very heavily institutional centered. And then the VIX futures themselves are a large market, and they trade almost 24/7 around the world. And they represent, the market's best estimate for volatility at all these various points in time. And it's prices, it's from trading. It's not like a sentiment, a questionnaire or something. It's actual money being put to work. So we really use that for our cues for risk anywhere.
I think it's brilliant. I think what you guys are doing is very, very smart. So years ago, I wrote a paper for Forbes talking about the VIX and how it measured downside volatility really well, but it did a lousy job of measuring upside volatility. So if the S&P would move, let's say 2% down, the VIX would shoot up. The S&P moves 3% up, it wouldn't move anywhere close.
Right. I think that's drawn from the way, the option skew works in the S&P. Not to get too in the weeds, but, obviously it's more heavily weighted towards the volatility is more on the downside than on the upside. So, and you'll see that more in the puts than in the calls. And that works its way into the VIX calculation. So downside fear affects the VIX more than upside, I guess what the opposite, greed would be. Yeah. We have seen it work both ways. I think what Mike described there in January of 18 was potentially like this big upside chase that actually pulled the VIX up from the call side for a little while. To us, it's still the same thing. You've got this imbalance of demand and imbalance of, we're expecting more volatility today than tomorrow. That's a problem for us, like a crisis signal.
Like it. So tell us about each one of the funds that you manage, please, and some more about your investment strategy.
Sure.
I'll start with MSVX is our alpha seeker strategy. So all the three ETFs that Matt and I manage for Little Harbor are built off kind of the same chassis, is just slightly different goals there. So alpha seeker is kind of our version of a liquid alt. So its mission in life is to be, up on a yearly basis as often as possible, regardless of the market backdrop. And it's, looking to that vol dashboard. It's looking for inflection points along the VIX curve that matter to us, and different levels that matter to us. And it'll use S&P 500 instruments to express either positive beta or negative beta. It'll use VIX instruments to express that same either positive or negative beta signaling. But it doesn't have a dedicated, long only index exposure like our other two ETFs have. So MSTB is our S&P 500 strategic index exposure that'll go between, in practice, 90 and 100 to 110% long the S&P, and it will use VIX instruments only in a protective manner when we kind of see that VIX curve flattening or go into backwardation. And the VIX exposure is 0 to 30% long. And like Matt mentioned, the protection when VIX futures are on is obviously important. But just as important, maybe even more important, is when know when not to hedge. So you don't have that continuous drag on the portfolio when the market environment doesn't, lend itself to hedges performing well.
Yep.
So strategic core of the S&P 500 and a tactical VIX component. MSTQ is the same methodology as MSTB, but the underlying index is the NASDAQ index, NASDAQ 100. So again, it'll go between 90 and 110 in practice on the NASDAQ side, and then the same VIX overlay.
I love it. And let's talk about risk. How do you manage risk, and what are some mistakes you see people make with respect to risk management?
I would say, so how we manage risk in the funds is essentially with the dashboard, watching the cues from the hedging marketplace itself. So our risk management looks to other risk managers and like, what are they doing, as quantified through that dashboard. So that's the biggest one, is just kind of staying tuned in with the environment as it is right now. As the VIX is telling us it is day to day. That's the biggest one overall, controlling the risk of these funds. And then in terms of like mistakes we see people making, I think I would keep getting back to people overhedge. I think in our experience, you can get rid of every drawdown, but you're not going to have any return doing that. So there's got to be some middle ground between, I want to protect against every possible downside movement or all volatility, and then actually making return in your portfolio. So we're trying to find that balance a little bit better between the expense and protecting against the clients that really matter. It's not the 4% corrections that come back a week later. You can spend a lot of money to protect against those, and overall it's not worth it to us. So biggest mistake is overhedging, spending too much money, where that's what we're trying to attack here.
Love it. Beautiful. And what about some timeless lessons you've learned along the way that you'd like to share with the audience?
Let's see, timeless lessons. Yeah, I think for us, just seeing how our methodology has reacted to different kind of events that have moved the VIX would be, sort of like our learning curve, if you will. So to us, there are like kind of two distinct types of VIX moves to the upside. There are what we call swells and spikes. So a swell to us is kind of protection or something that's bothering market participants enough to where protection is being gathered, that resulting in implied vol being bid up. And there hasn't been anything necessarily acute. So a swell to us is more dangerous, like something more financial system related, some big event that could cause kind of like, the 08 we saw basically a global margin call. So there's just, correlation one type of selling.
Yeah.
Spikes, I like to use like the Japanese earthquake and resulting tsunami in 2012 as an example of a spike.
Yeah.
So those spikes in the VIX, they're flashy in terms of, percentage move in the VIX, but those tend to mean revert or recede fairly quickly. as the market sort of gets comfortable, pricing like, hey, this isn't going to propagate out. This event is not going to propagate out through the financial system.
Mhm.
So sort of seeing or being able to tell what are spikes and what are swells has been, pretty valuable for our learning process with our own, investment process.
Yeah, I would just chime in with, we've been doing this for 25 years, and I've really come to the conclusion, and it's based on what, empirically what we've seen, is that outside of crisis periods, and we know how to define those with the VIX, outside of crisis periods, the expense of hedging makes it a negative expectancy. It's cost more than it saves outside of those crisis periods, and that's just the way we've seen it happen over and over again. So you got to really, think of hedging differently. Like we think of it like the twin risks of those big crisis periods are definitely times when you want to have protection on, and they are infrequent, but they're really impactful. And so those are the ones you got to look out for. Those are the ones that can really change your compounding kind of forever as an investor. So stay focused there for the risk management part, for the downside risk management, and then at all other times, the risk is yourself as the manager. You can really overhedge and create more problems than you're solving, trying to just mash out every little drip in the market. So that's really it. That's been my takeaway.
I love that. The risk is yourself.
It really is. Yeah.
It's so true.
Stay out of your own way, right?
Yeah, 100%. So let's next question, mistakes. What are some timeless mistakes you've made or you've seen people make, and how do you avoid them?
I think I'll start out with kind of the genesis of our vol dashboard process that we use. We were working at another firm back then when VXX and the first vol ETNs listed back in 2009. And we thought, what a great idea. We can sort of collect an evergreen position in these volatility instruments and wait around for, a spike or a move. And so it was seeing the bleed that was happening when nothing was happening in the VIX marketplace, the contango and the move down as we got closer to expiration in those VIX futures didn't have VXX for us go sideways like we thought. The cost to carry made itself well known, and so that really kind of kicked off our thinking. We're like, holy smokes, we have a highly mean reverting, non-tradable index. We can build a process around this. So so our first foray into it was losing money in those instruments, but then realizing it fairly quickly. That type of behavior shows up in some of the commodity ETNs, so on and so forth. So, starting out with a mistake was eye-opening for us, and it provided the light bulb moment for our investment process that we use today.
Yeah, and pretty quickly off of that, after that realization, we come up with the system, we have this dashboard, and I think maybe our second mistake there was maybe being 100% quantitative and trying to run this as a system without any other input. We thought that was probably a great idea to just let this be the only portfolio manager in the room, and it worked. We created some value that way, but overall, what we found out a few years in is essentially we could have, and we eventually moved to this model that we're doing today. Is our input in there as traders. It adds a little element to just the nuts and bolts numbers that are coming out of that VIX, and we can smooth out the volatility and come up with a better path that's actually more relatable and palatable to investors, that also creates value. So it's kind of blending in sort of the quantitative and the softer touch human side as well.
No, I love that. So you mentioned the light bulb moment. Just to help lay it out for investors, what exactly was the light bulb moment, and how can they learn from it or use it if any?
Sure. Yeah, for me, it was the difference in expectations of carrying the long vol ETNs back then and the results. So there's obviously a reason for that. So that that's the light bulb moment. What is going on between where my expectations were and the results, and diving into that, and then you're like, okay, I understand the mechanics. if you take a step back and think about the VIX index as this mean reverting statistic, it's not meant to be a total return type of thing like the S&P 500. So putting together all those pieces of, sort of the mosaic in that light bulb moment, that's what I mean is like a discovery, if you will.
Got it.
Yeah, I think I could sum that up. Like the light bulb moment was realizing just how expensive hedging is and can be. And so, okay, how do you use this better? It's a tool for sure. There's some uses, but there's some dangers.
Got it. So in other words, don't be scared at if the market goes down 2 or 3%, 4%, 5%, like which has happened in April. It's par for the course. It's normal. It's going to happen. So if you freak out and sell every time it goes down 1% or 4%, it's going to cost you a lot, because to your earlier point, where you're going to miss out on the upside. So
I think
yeah,
right. I totally understand being fearful when the market goes down. Of course, that's just always going to be with us as humans. I think our point is be careful how much you're willing to spend to make yourself feel better about these declines that really don't matter numerically, and you can really get yourself into a worse position spending so much money to protect against something that is ultimately not super impactful. These little drawdowns, you can spend more money protecting against them than you're ever going to save yourself. And so again, you can be your own worst enemy really quickly there. So it's just sort of trying to step back a second and look at the numbers and see, are you really helping yourself or are you doing something else?
gotcha. And that makes perfect sense. So what's the best piece of advice you'd like to share with the audience, or give your 20 or 30-year-old selves?
Well, buy let's see, NVIDIA.
Right.
That would have been a good one. I hate to keep dripping on it. I think just really thinking about your risk management more holistically is probably my best advice. And it's not just an interesting thing to say. It really, if I could talk to my 20-year-old self, hey, think about this more holistically, because it will provide you with a higher end value when by the time 20 years later, you're going to probably end up with more money if you can think of the risk beyond just little drawdowns. Think of yourself as a risk in that portfolio. That's going to serve you better. You're going to have much more, your assets will be higher probably in 20 years if you can think that way.
Yeah, I think kind of dovetailing on that, really, regardless of your approach to the market as an individual investor, try to have a framework that is consistent and repeatable. There are no perfect trading systems out there or perfect crystal ball investing processes out there. But if you just rattle back and forth to either the latest trend, or you're constantly switching signal services, or whatever it is, the sort of inconsistency over time applied will probably result in worse outcomes than just passive indexing. So a process or a framework that you can consistently rely upon to get you through those tougher market times is definitely helpful.
Love it. Well, gentlemen, thank you so much. Again, the tickers are MSVX, MSTB, and MSTQ. How is the best way for people to learn more about Little Harbor Advisors, or what you guys do, or get in touch in some capacity?
Sure. There's our website, lhafunds.com. And then Rick Tomney is our head of wealth management and sales there. And he'll be happy to answer any questions that any prospect or investor may have.
Beautiful. Well, thank you, gentlemen. This has been fantastic.
Thank you, Adam.
Thank you for having us on.
Thank you.